See, stress testing has come out as one of the outcomes of the major economic crisis that came out. The reason being most of the scenarios which the companies test is generally based on VAR. VAR has become one of the powerful tools for risk management, probably for the last 2 decades or whatever. But the major problem has come out that if we see the way the VAR is calculated, we compute the mean as well as standard deviation, and we say mean minus probably 1.96 times standard deviation or 2.33 times standard deviation, something like that. Now, depending on 1% or 5% kind of a var, whatever we have to compute, we are computing it through this kind of a process. Now, the mean and standard deviation are purely calculated from the data itself. From the historical data, you are calculating the mean and the standard deviation. So, what was happening was, if there was a very extreme scenario, let's say something has not happened in the last 1 year, last 2 years, some major economic loss or economic situation has not occurred in the last 1 2 years, but you have taken the mean and the standard deviation of your last 2 years and you have computed the var. What will typically happen is, beyond a certain point, your var is not able to predict that extreme losses, right? Because generally, okay, we are typically seeing this, the mean, standard deviation, so 99% var also may be somewhere here, right? So what is this extent of 1%? It's not able to predict. And at the same time, this particular amount is computed based on the last 1 year or last 2 years historical data. Let's say one classic example which I have observed pretty recently, Infosys share price. Probably if I have looked at in the last, leaving out the last year, 2 years before that, the maximum loss on one single day for an Infosys share was not even 10%. Probably in the years 2009, 10, 11, even when the economy was down, their share price was never down more than that 10% on a single day. But so when some investor might have computed the VAR for the investments in Infosys, the mean and standard deviation, whatever would have come out, would have been purely based on those calculations. And they would have computed your VAR requirement to be much lesser also. There is a 1% chance that your loss would be more than 5% or 7% in a one single day. But in the last year, if I had seen, there was a 22% fall on one single day, right? So if that had been the case, probably the investor who had bought the shares of Infosys, he might have gone very heavily bankrupt also, right? It could have taken him to such an extreme situation, which means the VAR models which are being used, they can generally predict the most common behavior, but they are not able to test out those extreme behaviors. Probably if the share price falls by 22% or 25%, do I have a mechanism, right? Do I have a backup for that? Otherwise, that particular company would have got, any investor in Infosys, he would have got into a cash flow crisis, and which could have led to a series of problems after that. So for these kind of tests, we are talking of a stress testing kind of a mechanism. Mostly after the financial crisis, the need for stress testing has become very high, and that's where it is said that you use this stress testing more as a complement to VAR and not as a substitute. So VAR will model your more regular kind of scenario, but apart from the more regular kind of scenario, you focus even on the very extreme conditions also. And how do you decide those extreme conditions? We are talking of from two different standpoints. One are the event-driven scenarios, the other is a portfolio-driven scenario. When we talk about an event-driven, you visualize what all events could result in extreme losses, whether it is on a credit front or a market front or on operations front. Probably what could be the various scenarios, various events, probably mergers. Are we thinking of any kind of a merger? If there is a possibility of a merger, what could be the extreme fall in the share price that could occur? Right? Or probably some other natural calamity. If there is a natural calamity, what could be the kind of maximum loss that can occur because of operations or because of market or whatever? Or the exchange rate fluctuation, the current scenario. Right? Probably there could be a lot of companies which are losing very badly because of the current exchange rate fluctuation. Right? So, and they are not normal movements. In one single year, the exchange rate fluctuation of this much percentage happened very rarely. Right? Probably almost, I think 30% at least, 30% could be the increase in the exchange rate within the last 1 year period, which were very rare occurrences in the historical past. Now, what could be the impact because of these kind of events on my portfolio? So you visualize various such kind of events and test your portfolio, whether it is an asset portfolio or a investment portfolio or whatever. Test your portfolio for these kind of extreme risks. Similarly, when we are talking of portfolio driven, you identify your entire portfolio. What could be the maximum loss, or what is the amount of loss you are willing to bear on a one single day? And based on that, you translate it into what all factors. Instead of one single factor, you list out all the possible factors. Just one example, like if I am borrowing short and lending long, like I borrow for a short term. Banks do this in a very large number of scenarios. They borrow on a very short term in form of deposits. Most of their, the deposit money is generally for a short term period. But they are lending that money for housing loans. The deposits which they are getting, probably they may be withdrawn at any point in time. But the deposit money, which is what is a borrow short, from a bank standpoint, they are borrowing for a short term, but they are lending for a long term. So in that case, what is happening? If the interest rates are going up, they would be exposed to a risk, because today, okay, to the investor, they are given, from the depositor, they are giving to the depositor probably 4%, 5% kind of interest rate. And they are lending it, let's say at around 10% for a housing loan. Right? Now, if the interest rates are going to go up in the long term, 11%, 12%, they are losing out on that 1%, 2%, because they have lent it at a long term period. If the interest rates are going up, probably the next year deposits that are coming into the bank, they have to give a higher rate of interest. But whatever they are getting in the form of interest on loans, they are getting the same 10%. So overall, their margins are going down. That is what is the risk they are exposed to, right? So those kind of things have to be clearly identified and tested as a part of the stress testing process. So which cannot be given by your regular VAR kind of model. In that, what we are saying is some of the scenarios which are generally identified by the derivatives policy group, which is like, okay, parallel shift in the yield curve. Assume that the interest rates will increase by 1%, some extreme, regular change by 0.25% and all, they are normal scenarios. But test out, what if the interest rates across the term structure increase by 1% or decrease by 1%? Some extreme scenario which might have occurred very rarely in the historical past, not in the last 1 year or 2 years. It must have occurred at some point in time in some country, may not be in India, but try to see what is the chance of occurrence of these kind of scenarios, and make sure that you have an answer for if the interest rates change by 1% or up or down by 1% suddenly overnight. or probably steepness in the interest rate curve changing, which means probably the short term ones are are increased heavily, but the long term ones did not change much, or vice versa. Or probably you are looking at both of them, parallel as well as non parallel shift, or talking about yield volatility. Every month the interest rates are changing drastically, up down. There is a lot of fluctuation in the interest rates every year, right? So these are generally, these may not have occurred in the last 1 year 2 years. If I'm just taking the last 1 2 year data to build my model, all these scenarios would not have occurred at all. So what the stress testing mechanism is saying is, these are all one variable sets. So you just focus on one variable at a time, right? Interest rates, if they increase by 1%, what is the impact on my portfolio? Interest rates, short-term interest rates increase by 2%, whereas the long-term rates change only by 0.5%. What is the impact on my portfolio? Like that, you are trying out the various combinations. You are not looking at the combining all of them. Individually, you are looking at the impact. These are what typically the word sensitivity is also used in this scenario of where one variable is changed and you are observing the output variable. Output variable here is your portfolio value, right? Changing one of these. So probably changing the value of equity index. In a year, equity index falls by some 20%, which might have happened very rarely in some country. But I want to test that scenario out. Do I have a backup even if the interest rate falls by, or even if the equity index falls by 20%? Similarly, we are talking of equity index volatility. If the sigma of the equity index is something like this, what could be the impact on my portfolio? Similarly, currency exchange rate, the current scenario where we are operating in. So if the exchange rate, see, it could have very much happened. Actually, the story of one of the companies, probably in our, I think we'll see them in our case also. There is a company called National Australian Bank. This bank, number one bank of Australia, it has gone completely bankrupt just with a 10 cents change, 10 cents drop in the US dollar to the American dollar. The exchange rate, American dollar to US dollar, there was a drop by 10 cents, and this company had accumulated, this bank has accumulated a loss of 550 million American dollars, and which has resulted 360 million American dollars, which has resulted into a closure of the bank altogether. So that small change in the exchange rate had, because they had very severe positions in the forex swaps and options, they betted on US currency appreciating. Whereas, so based on that, they have entered into very huge positions in the swap market, on the forex swap. But it so happened that the US exchange rate has gone down. The size of their loss has mounted to almost 550 million. And now, because of that, margin, depositing of the margin, creating cash flow crisis. And they are not able to furnish that cash flow, which has resulted in a huge loss in the whole portfolio for them. So that is where these kind of scenarios come up, that you have to test for all these kind of changes. So volatility in the forex rate, swap spread rate, all these kind of things you have to mandatorily test as a part of one variable test, which means you don't club two variables together, only one. Okay, interest rates go up by 1%, what is the impact? Exchange rate go up by 20%, what would be the impact? So you are not clubbing, what if the interest rates go up and the exchange rate also goes up? That will come into a scenario analysis. If I am taking only one variable at a time, which is like a unidimensional scenario analysis, is otherwise called as a sensitivity analysis. So if I am taking more, so I think I'll come back. So in the scenarios, Either I can create a one dimensional, which is more like your sensitivity analysis, whereas multidimensional is actually technically called as a scenario analysis, wherein in unidimensional, just like the way we have seen just now, I identify one of those 9 variables, right? And okay, assume larger movement than predicted by recent history. So in the recent past, the interest rates have changed. I mean, maximum change in the last 5 years on the interest rate in 1 year, let's say, was 1%. Now probably check it out for 1.5% or 2%. Equities in any 1 year in the last 5 years, the equity fall on one single day or one single month or one single year was not more than, let's say, 15%. So you look at it as 20% or 25%. So make that larger movement than what is predicted by the history, because the larger movement itself is an extreme, because what the bar model is giving is the average and the deviation from the average, which is again average deviation. The standard deviation definition is average deviation from the average. So it's not the extreme deviation from the average. So even the extreme value itself is a kind of stress test, but you are taking even the extreme to the extreme, slightly more than the extreme value also. That's where you are trying to test, and you are revaluing the portfolio and all that. But the biggest problem is, if there are multiple factors that are operating, the correlation between the factors is, I mean, if there are two factors, let's say interest rates are going up as well as the exchange rates are going up, right? If I cannot consider two variables here, but it might be possible that because of the two variables taken together, the overall impact could be more than each variable in isolation. So because of that, because of the correlation that is existing between the multiple combinations of the input variables, there was a need for multidimensional scenario analysis, where we are talking of consider all the relevant variables, build models where you are trying to find out the correlation between all of them, and try to look at the final impact on the portfolio when all of them are operating together. It's not a simple addition of this plus this impact, because of the correlation. If they are very highly correlated, probably the impact could be much more. But if there is a big negative correlation between them, the impact could be much lesser, just like a concept of portfolio analysis. So, but the biggest problem in this is how many such factors I have to take. Interest rates, equities, exchange rates, how many I have to take, and what is the kind of correlation between each of them. And we have seen in our earlier chapter, correlations change with time. Today they may be very heavily correlated, but after 1 year the correlation between them would actually go down or might even go up. So what is the time period I should choose for finding out the correlation? They are all challenging, and they all have to be modeled by the analyst. So that is where the risk management with a multidimensional scenario, the stress test with a multidimensional scenario analysis becomes much more tedious, but it is much more robust if you are able to do at least with a few risk variables, finding out the correlations between at least few risk variables, and you are trying out computing the value of your portfolio under each of these dimensions. It is much more robust compared to going with a one-dimensional scenario kind of analysis. So that's where it is saying identifying several risk factors and even the correlations and the time period to be considered for the correlation, all of them are challenging aspects. And typically we also see one of the most effective unidimensional system which we see is the margin determining system, which is typically used by the exchanges for the futures, or they decide the margin requirement. The way they decide the margin requirement is actually using an algorithm called span system. The typical way it works, see, basically from an exchange standpoint, if you see, they cannot decide a very small margin. If the margin is very small, probably the scope of default is much higher. right? Probably if I'm setting a very small margin, in one single day, if the price changes beyond that, there is a good chance that the other counterparty will default and exchange will lose. But at the same time, if the margin is set at a very high limit, the number of contracts that would be traded will actually go down. Because if X amount has to be deposited as a margin and I have 1000 rupees, if 100 is the margin, I can hardly place 10 trades. But if the margin is set at only 10 rupees, probably I can place 100 trades. So the exchange will get the commission on the 100 trades. So it would have got much higher money, but at the same time there is an increased possibility of risk that is coming in, because if the price changes by more than 10 in one single day, the counterparty will default and exchange has to bear that risk. So it has to decide the margin in such a way that it is not too high nor too low, so that it's an optimal number, so that it does not lose out, and at the same time maximum number of trades are executed on the exchange. So that is generally evaluated through this span system, which is typically used to decide. So all the overall portfolio risk, the exchange will capture the data regarding the overall portfolio risk and load it to various sets of alternatives. If the exchange rate goes to this much, or if the interest rates drop by this much, because historically there might be some data when RBI has changed the interest rate by 0.5% on one single day. What was the impact on the stock market index? 5% increase, 10% drop. What is that? Or similarly, when the exchange rate on one single day has changed by 2%, what was the impact on the stock market index on that particular day? So they will have historically all possible scenarios which are going as a computer algorithm, the span algorithm, based on which they are trying to decide. So they are loading it with various stress testing one-dimensional analysis scenarios, or at the max 2 or 3 risk variables, so that the analysis does not become more complicated because of the correlations between the risk variables and all that. And the number of scenarios which are being used are very, very few in number, so that they become more and more manageable to discernment what should be the margin amount in the process. So again, when you get into the multidimensional scenario analysis, you can resort to either the historical approach or a prospective approach. So when I'm talking of historical, look at the historical changes in exchange rates, historical changes in interest rates, historical changes in the equity index. So basically from the historical data, which is more of a backward looking, you try to find out, what was the correlation between the interest rates and exchange rates? What was the correlation between interest rates and equity rates, equity index? What was the correlation between exchange rates and equity index? All these kinds of correlations you can find out on the historical stuff. But the biggest drawback is, only if the historical event has occurred, then only it will come into my analysis. Probably if the historical event has not occurred, let's say 1% drop, or equity exchange rate increasing by, or domestic currency depreciates by 5% on one single day. If these things have not occurred in the past, they will never come into the data, so they cannot be considered as a part of the correlation analysis at all. So at least each event should have occurred few number of times. Otherwise, they cannot be included, and the various features are unique also at lot of points. So today the interest rate has gone up by 1%, but it could be because of some specific reason. So there could be an event associated with it. So identifying the whole chain and the link is always a tedious process. And because of that, you need a very long historical data, probably last 10 years, 20 years kind of stuff. Whereas when I'm going with the prospective approach, it is completely forward looking kind of stuff. And what are we doing in this? I'm generating from some reasoning. Okay, what could be the change? If I'm assuming interest rates changing by 1% on a day, exchange rates increasing by the unidimensional, whatever the numbers we are taking, I will take the scenarios of the multiple variables that are coming up, and modeling wise I'll try to build up the relationship between each of them. Instead of going ahead on a historical trend, I can use a futuristic forecasting kind of an approach to estimate what could be the possibility of the interest rates in the next few period. What could be the exchange rates? Again, I can draw kind of binomial trees kind of stuff, saying there is a 5% chance that the exchange rates can touch here, 20% chance the exchange rates can touch here, and so on. These kind of things can very well, and even conditional scenarios can be created. Like if the interest rates go to 1%, like a binomial tree, interest rates going up by 1%, interest rates going down by 1%. If the interest rates go up by 1%, again probably exchange rate going up by this much percent, exchange rate going down by this much percent. So such kind of conditional scenarios also can be computed. And when you are computing conditional scenarios, again the correlations can very well change, because we are testing for correlations in various market conditions. If the interest rates are going up, the correlation between interest rates and exchange rates could be something. If the interest rates are going down, the correlation between interest rates and exchange rate could be something else. So in each of the scenarios, we are giving weightages, and based on that, we are trying to find out what could be the amount that could be at risk for us. So when we are talking of sensitivity analysis, one single input we are changing and trying to find out what could be the impact on the output which we are trying to observe. That's a word of sensitivity analysis. But whenever we talk about scenario analysis, we'll talk about multiple variables changing together. So probably we'll think of a best case scenario, worst case scenario, moderate case kind of a scenario, or most probable kind of a scenario. And based on that, change all the input variables accordingly, and use those things to estimate our value of our portfolio. So, but typically what are being observed as a part of weaknesses is board is not generally involved as of today. So senior management does not know what is happening as a part of stress testing process, right? It's only the risk management group. They come out with some kind of risk management, the stress testing scenarios, and they test it out, whereas the board and the senior management are not heavily involved. That is the survey report that has typically come out. And overall organization also feels that this is a job of some specific department in the bank rather than a culture in the organization. So even the methods for stress testing, what kind of distributions have to be used, what kind of formulas have to be used, what is that extreme value that has to be tested, no proper guidelines that are existing within the organizations today. And if at all the crisis comes up, what kind of response is there? What is the contingency plan for the companies or for the banks? Even those things are not properly in place. That is where some recommendations also have been given as a part of the principles of supervision on stress testing. What they have clearly come out is it's a part of the organization's overall risk management and governance framework. So you have to come out with various techniques. What are the various scenarios that would be tested? What are the unidimensional and what are the multidimensional scenarios that would be tested as a part of stress testing? On what basis the revisions to each of these approaches also will happen? That's a kind of a documentation or a policy document that comes out as to how the stress testing has to happen. So a lot of infrastructure and systems and models and all have to be developed on these lines, which also includes the regular auditing process and documentation process. And so from these, you are coming out with overall organization-wide stress testing mechanism to arrive at what would be the total amount that could be at risk.